Welcome out to the BluSky Trading Lab, guys, every Thursday, right after the market closes. The topic I want to talk about this week, and what next week, we'll talk about next week here in just a moment. But the topic I want to talk about this week is the labor market and the labor market report tomorrow morning. I want to take a look at previous editions of the labor market report and kind of identify how not really kind of what was reported. Was it a beat? Was it a miss? Was it in line? What's going on with wage growth and all that jazz? Like, that's not important to the conversation here today. The conversation here today is try to understand what is the typical path that happens after the major economic report known as the labor market. When you look at the economic landscape, ladies and gentlemen, and there's a lot of good economic calendars out there. The one that I personally use is Forex Factory. When you look at the economic calendar on, just your average week in the marketplace, you're going to get a tremendous amount of different types of economic reports. Every single month, you got about 10 to 12 different economic reports that are what I would label as very, very important economic reports. For example, when you go through the month and you just kind of look at the red ones here, I'm not going to pull up the non-vitally important ones, but when you kind of look at it week to week to week to week, and let's make sure that we're kind of looking at the current month very quickly, September. So, for example, this week, the number one major economic report is the labor market. It comes out on Friday, 5:30 a.m. my time, 8:30 a.m. Eastern Standard Time, right about an hour before the market opens. And obviously, this report is going to have a sizable impact. How important is the labor market report? Well, right now, it's the number one most important report to the marketplace. And the reason it's the number one most important report to the market is because the central bank is anchoring against this report for monetary policy. And when you're talking about monetary policy, there's a dual mandate. One is to maximize labor. That's the first mandate. Maximize labor. And the second one is don't spark hyperinflation while you're trying to maximize labor. So the dual mandate is number one, maximize labor. And number two, while you're attempting to maximize labor, you have to control inflation. And so you have labor versus inflation. Those are the two major economic reports. Which one's more important on a month-over-month basis will be dependent on kind of which one the Fed is focusing on the most. Well, the one the Fed is focusing on the most right now is the labor environment. And so labor report tomorrow is a very important report. It's an important report every single month. It's not the only important report, however. Like, for example, when you talk about next week, you get CPI report. That's a major economic report. Obviously, inflation, CPI fits the bill. The week after that, you get the Fed meeting. The week after that, I'm talking just the major ones out there, you get the core PCE price index. The week after that, you get another labor market. But in general, when you're talking about all these 50 different economic reports on a month in, month out basis, guys, there's really only like 3, 4, or 5 that have a sizable impact on the market, where the market will price things in, and the labor market is one of those. And what that means is we have a greater expectation tomorrow of price movement than we do in a normal trading session, obviously. Even when you have manufacturing data, for example, you don't have an expectation that the ISM manufacturing data is going to move the entire market. You don't have an expectation, despite the fact that PMI services came out today. I didn't really hear anybody talking about ISM services here today. It might be colored red, but it's not. It doesn't mean that it's a major market economic report, because those major economic reports move the market. It takes up all the oxygen in the room. Everybody and their dog's talking about it, and they're talking about it through the lens of how does this impact monetary policy. Nobody asked that question today after ISM services. Nobody asked that question on Tuesday after ISM manufacturing. But you know what they did? After the JOLTS report on Wednesday, they started asking that question. Labor and inflation are by far the two biggest movers in the market. By far, the two biggest movers economically are the CPI report next week and the labor market jobs report that comes out the first Friday of every single month. Obviously, that report comes out tomorrow. So what I want to do is I want to take a look at the market historically. So what we're going to do is we're going to take a look at the last four labor market prints. How did the market respond to the economic report? How much time did it take before we got some degree of technical pattern and before we felt like there was a good situation to be to find a tradable situation in? No, we're talking about price tipped. Okay, so the last four data prints were right here on August 1st, right here on July 3rd, right here on June 6th, and right here on May 2nd. And so when I just wanted to show you the daily chart where those are. Now, obviously, we got one big time negative down day. We got a good up day. We got a good up day, and we got a good up day. 3 out of the 4 last labor market prints were positive. Now, 3 out of the last 4 labor market economic reports were also positive. And so those were also revised vastly to the downside. Now, this one right here, guys, it's a little bit unique because we were dealing with the Fed from 2 days earlier. So what I'm going to do is we're going to go down into the 15-minute chart. That's kind of an execution time frame for me. I like to look at the analysis on a 5-minute chart, on a 15-minute chart. We're going to do it on a 15-minute chart so that we can quickly go back in time and look at kind of that data and that analysis. So when you go back in time and we look at the first economic report that was reported, that was last month. It was on August 1st. Now, once again, does it really matter to our conversation here today? What was it, a beat or was it a miss? Does that really matter to us from a technical perspective? What do you guys think? Doesn't matter if it was a beat or a miss. Doesn't matter what the economic report suggested. No, it doesn't. Which means if it didn't matter historically, should it matter to you should it matter to you tomorrow as a trader if it's a beat or a miss? No. So tomorrow, when we're all seeing that data come in tomorrow, should we have the conversation immediately being like, do we trust the data? Should we have that conversation immediately as the market is pricing in the data? Because I know that's in the back of the head, right? Okay. No. The answer's no. I knew that, RQ. The answer's no, because again, that's going to be a fun conversation for all of us next week when we're just having conversations in Riz's stream and Power Hour. But when we're talking about that data coming into the market tomorrow, it is not about the data. It's not about the data on August 1st. It's not about the data on July 3rd. It's not about the data on June 6th. It's not about the data on May 2nd. And it's not about the veracity and the viability of that data tomorrow. It's about how does the market respond to the data as it's coming in. And can we find an edge from a tradable situation? Because our job as traders is what? We have one job as a trader. What is it? What is our job as a trader? It's the only job we have. It's to make money. That's it. That's our only job. It's not to be right. It's to make money. So tomorrow, when the rest of the world, because you know what's going to happen, guys. You absolutely already know what's going to happen tomorrow. Everybody's going to have a political discussion on trusting the data, and that's fine. Enjoy it, but not in the marketplace. In the market, we trust the price response to the data, not the data itself. Does that make sense, everybody? Okay, good. Now, after all that's said and done, can we geek out and make some fun and have a little fun and all that? Of course, of course. I'm just talking about when you are in that mode of I have a job to do, treat it like a professional. It's not about the data, it's about the price response. Now, when we saw the price response, here it is right here. We're looking at a 15-minute chart. Here's the initial price response to that first labor print on August 1st. Now, in the first 15 minutes, guys, and really probably 30 minutes after a major economic report, not minor economic reports, but major economic reports. Well, let me ask you a question very quickly. On the cash open, do you find yourself to often give it a little bit of time before you feel comfortable with the read? Yeah, right. Because on a cash open, what's occurring on a cash open? You have all these orders from the overnight action coming into a needle-sized hole at every broker, and a lot of action takes place. A lot of volatility initially ensues. And initially, it doesn't take long, but initially, there's a little bit of inefficiency in the pricing of the market on the initial cash open. That's the entire logic behind what's known as a common gap is it happens on indexes, ETFs, individual stocks. We don't see it in the futures because the futures are open. But a lot of times, what will happen is you'll see a common gap occur in the market at the open. And that common gap is based on inefficiencies to a certain extent. And so it takes a little bit of time just to kind of smooth that out and get the market back into an efficient state. On an economic report, the initial reaction takes less than a fraction of a second, guys. You got to understand how this game is played. This game on economic reports like this, let me put it like this. About 10 years ago, there was a hedge fund out of Chicago that was paying the University of Michigan $1 million a month. Now, I want you to think about this. They were paying the University of Michigan $1 million a month to get the University of Michigan Consumer Sentiment Report a fraction of 1 second in front of the rest of the market. Meaning, when that report was released, who did it go to first? It went to this hedge fund less than a fraction of a second in front of it going to the rest of the market. Now, why would this hedge fund want to get economic data less than a fraction of a 1 second, which, by the way, is illegal? It is highly unethical, but it was happening nonetheless. Shocker, something unethical happens in the stock market. But why would they do that? Why would that hedge fund pay that much money to be a fraction of 1 second in front of the market? Why would they do that? Is it to read the report before everybody else? Is it so that they can have they can read the report and have an understanding of the data before anybody else? Or does that report feed right into their algorithm? And if it's a beat against expectation, market goes up. And if it's a miss against expectation, market goes down. It's just to get the ordering, guys. That's all it is. It's just to front run the other algorithms. That's all it is. And so if you know that, and you're not that algorithm, do you want to battle in an algorithm war that is happening on fractions of seconds? The answer is no, right? The answer is no. What we want to do is we want to let that volatility smooth out, okay? And oftentimes, what we will see is a secondary setup that happens within probably about 30 minutes after the release of the initial report. And so what did we see last time? Well, the first 15 minutes of the report was a wide range candle. And let me ask you guys a question. What is the orb? We talked about this 2 weeks ago, and obviously you guys have this conversation quite a bit every day. What is the orb? It's the opening range breakout, right? It's the opening range break. And how we look at that opening range because of the volatility of the cash open, correct? Can we use a similar technique in understanding these key economic reports? If the same type of volatility is going to happen on the cash open that happens on the economic report, well, I kind of feel like we can look at the same range to have an understanding of where those algorithms are playing in. Okay, because it's the algorithms that really kind of drive that report. It's not you and I. People don't even have the context for what the report did. I'm literally looking at the data, trying to understand the data, and the market's already moving a percent on the report. These things happen fairly quickly. Now, back in the day, guys, I used to treat this a little bit differently. I wouldn't wait I wouldn't wait on the economic report. What I would do was I would put an order in the market to either get filled, and I would do this before the report. I would put an order in above the high of the 15-minute candle range, and I'd put an order in below the low, underneath the low of the 15-minute candle range. And that, when I first started trading, guys, for the first like 7, 8 years of the market, that was fantastic. It was absolutely fantastic. And then all of a sudden, I started getting smacked in the face with that type of trading. And I was like, what in the world is going on? I called up my mentor and I said, what in the world is going on? I'm doing exactly what you taught me how to do. And yet I'm getting blasted constantly by volatility. And what he said to me, and it rang true, was you have to adjust as the market adjusts. When I first started trading, 10% of the market was algorithm based. Now, what is it? It's like over 90% of the market is algorithm based. And so you have to adjust. And so because what that initial move in the algos, guys, there's no context to it. There's no understanding other than, was it a beat against the headline number or was it a miss against the headline number? The secondary reaction has both algorithms and Wall Street and humans and all of us after a little bit of context. And so you now see it through the lens of, okay, where is that opening range? Where's that opening range? And what is the secondary development after that? And what we saw in last month's labor report was the opening range kind of just created a situation where it came into the previous low right here. That's where the wick right here is. And then you had the top level of the range right here. Now, going back to the orb concept, in the opening range, are you looking to be aggressive when it's inside the range, or are you looking to be aggressive as it expands outside the range? It's outside, right? Okay, so on this next candle right here, did it give us anything? No. On the candle here, did it give us anything? No. But what it's doing, okay, Jesse Livermore would be foolish to play in the range. But what it's doing is it's dialing in the potential breakdown. And then when it breaks down right here, that's the trigger. So how much time did it take between the labor market release and the time we got our first trigger? That was from a pure technical. It took about 45 minutes. It took about 45 minutes before we saw the semblance of where that real great trade was. Does that make sense, guys? And does this help in understanding how the market functions on these key economic reports? Okay. Now, so what we know is the market moved in the direction of the previous trend after the volatility in the first go around. And it took about 45 minutes before we got a great trade underneath the orb, which just so happened to coincide with the previous level of support. All right, let's go look at the next one, see what we can learn from the next one. Now, the next one right here, let's kind of scale in here. This one here, we saw kind of a previous little bit of an uptrend, the previous trend, bullish, little bit of stabilization. Now, the range, here's the report right here. This is the opening range right here. Now, if we take what we looked at last time and we treat it in a very similar situation, you have the top end of the range right here at the 96 level. You have the bottom end of the range right here at on the key economic report right here at the 79 level. So once again, after the economic report, we're not really being aggressive in the economic report. Okay. We're not really looking to be aggressive. It doesn't mean there's not trades there, guys. Like there's scalps there. I'm talking about a standardized day trade, letting things set up on a 15-minute chart, 5-minute chart, stuff like that. There is going to be potential scalps inside the range for the ultra, ultra, ultra aggressive. But for 95% of most day traders, I'd say patience pays here. I really do. One of my sayings I have is it doesn't pay you to have an opinion in that moment. And what I mean by that, guys, is in America in 2025, the year of our Lord 25, everybody has an opinion regardless of evidence. Can we all agree with that? Like everybody has an opinion, evidence doesn't matter. Well, in trading, when you have that range, it doesn't pay you to have an opinion in that range. There's no edge there. You're RQ the edgeless in the range. Where does RQ get the edge? He gets it as it breaks the range. And so once again, what did we see following that? We saw a 15-minute inside candle. We also saw that last time, by the way. Okay. We also saw that last time. Inside candle was the first 15-minute was a little bit of a pump. The second 15-minute was a pullback. Okay. Now the third candle last time kind of dialed in a support test. This candle, the third candle, starts dialing in a resistance test. And then about 45 minutes, right as the market is starting to open up, the market takes that edge, breaks out of the range, and it's off to the races. So in the first report, the volatility lasted for about 45 minutes before it simmered down and got more into its prototypical trending situation. This one here took about 45 minutes before it simmered completely down and gave us a little bit of a situation. Now, after 5 minutes, this looks like a pullback here, right? But in general, it takes a little bit of time. What I usually see, guys, on a standard economic report with some degree of sensitivity to it is it'll take about 30 minutes for things to smooth down and really create secondary patterns. Because in these environments, guys, I'm not looking to just catch a trade. I'm looking to catch a trend. And I want you guys to understand that. Because if you're just looking to catch a trade, like you can catch a trade inside range, anything can be a trade. But if you're looking to catch a trend, you're looking to catch more than just an individual move within that. And so to me, it's always about the secondary setup. So too often times I see traders always try to rush to get in front of things when a report is released. And I see a lot of those types of traders complain when they get whipsaw. Well, the data historically suggests there's whipsaw. That's kind of what the data suggests is there's a little bit of whipsaw in the initial pricing of an economic report. We saw that on the first one. We saw that on the second one. Um, Ace, I also looking 50% pullback against the data candle, soft confirmation. Um, yeah, I think you could say that on both the first and the second one. Like I said, both of them on a lower time frame would have been seen through a pullback lens, right? So if you're on a 5-minute chart versus a 15-minute chart, this little snapback looks like a pullback, and just based on my eyes here, you're probably around a 61% pullback there. And so yeah, you could always see it through that. I choose not to look at Fibonacci pullbacks in key sensitive volatility environments because they're a little bit sensitive, and I'm not looking to pick up the pullback. I'm honestly not, guys. I'm not looking to pick up the pullback inside a range that I'm not comfortable to trade in. I'm patient, and I think patience is a position. I think patience is a strategy, and that patience is based on the fact that once again, I don't think it pays you to have a strong opinion inside a volatile range, especially that's driven through algorithms. It doesn't mean there's not trades there. It doesn't mean you can't find some success. It means it's difficult, is what it means. It means it's not, like we talked about last week, it's not clean, it's dirty. And when it's dirty, it can be choppy and it can be difficult to determine where to put a stop loss and all of that jazz. Whereas if you wait on that, like for me, if the pullback's legit and the pullback works, well, if that pullback works, my breakout's going to be fantastic. And so I'm just willing to give up a little bit of the profit potential inside the range to get a much better probable outcome outside the range. Does that make sense, guys? And it goes to what Tip says. Like, yeah, the trend's your friend. Trade the trend. And that's kind of that's kind of what the conclusion here is. Because if the initial movement is real, that's not the only pricing we're going to see. That's just the initial algorithms that are really kind of dominating in that atmosphere. But a very similar situation. Would you agree that from the August report to this report, very similar pricing? A little bit different. One was bullish, one was bearish. But in terms of the behaviorals of the 15 minutes, the first 15 minutes, and the behaviorals of the second 15 minutes, I kind of see a lot of consistency here on those first two. Now, let's go look at the other two very quickly. So let's go out in time a little bit. Let's go to the next one here. Now, the next one here, okay, right here. Here is your candle. Here's your opening candle. Right here. There's your opening candle. Now, this one here, this was June, by the way, June 6th. This was a pretty decent report. It came out with beats. Wage increases were up 0.4 versus 0.3. Like it was a pretty good economic report. Now, this one here was really clean the entire time. Okay, so we got the report right here. Big pump up, big pump up. Now, this is one of those ones where I wish I would have just done it like I did in the old school days. Order above the 15-minute candle range right there. That would have been pretty. But again, usually not the case. So here's the opening range, 15 minutes. One inside candle kind of dials that in. Does this give you enough, in your opinion, for a trade right here on the breakout as it's breaking the opening range? One inside candle, upward movement in price. That's about 30 minutes after the initial report here. Is this a trigger? Yes or no? You're breaking the opening range of the report. What do you guys think? Yes or no? Yeah, Tip, we had three in a row and they all got revised pretty nasty. Yes, once again, guys, I don't know if it's going to be 30 minutes or 45 minutes or whatever the case is, but once that establishes the range, can we agree that in the first three situations, the second 15-minute candle was not a trigger candle? Can we all agree with that? The second candle on the 15-minute chart was not a trigger candle. It was a development candle. You got your first initial move algorithm, that first 15 minutes. The second 15 minutes was either a pullback or consolidation. If it went down like it did on the first report, the next candle was inside. The second report, it went up. The second candle was inside. The third report we're seeing here on your screen, big upward movement in price. Next candle, slowing momentum, high inside. That's a defensive posture. High inside is defense. You would not see that as a negative. You would see that as a positive in pattern development. So I think what we see in the first few is, number one, only 1 out of 3 would have been good on the initial trigger. 0 out of 3 would have been good on the second candle. 3 out of 3 would have been good on the third or the fourth candle. Does everybody understand kind of where we're at here? Which means, once again, how much time does it usually take for the labor market to cool down and give us a secondary setup? It takes minimum 30 minutes so far. minimum. It's right between 30 and 45 minutes, which means tomorrow, when we see that initial move, right? When we see that initial move, that's one thing. But as the market develops over the next 30, 45 minutes, should we be paying very close attention tomorrow to that third, fourth candle on the 15-minute chart? 100%. Okay. I don't know if it's going to play out the exact same way tomorrow, right? Nobody knows that. What I do know is that if I did this same technique on every single economic report, you would see a similar outcome here, guys. You oftentimes see that very aggressive algo move in the first, and then you see a kind of a stabilization, slowing momentum candle on the second, and then you see the real move on the third. That's kind of how we've seen this play out on the labor market print itself. Now, on the last one, let's go back in time a little bit. The last one's right here. Let's see what we can see here. Now, on this one, here's the labor market print right here. Right there. Now, on this one, this was I'd say this one was a little bit of a mixed report, but a big time beat on the tips. Before you upset it, it was a big time beat, but it was a bigger revision, quite frankly. Okay, so when you're looking at this one here, a little bit of a different story. Here's your first little move here, sets the range right there and right there. Now, this one, the second candle, nothing was inside. Nothing was inside. It continued until it formed a retracement. And so you certainly could have taken the breakout here, but this was more of a momentum trigger. You certainly could have taken the breakout right there. Wouldn't have lasted before the retracement. The retracement was a pretty good one. So I would say 3 out of the last 4 had a very similar behavioral analysis to it. Okay. I would say 3 out of the last 4 had a very similar behavioral analysis to it. 1 ran, the other 3 developed. So tomorrow, much like everybody here, tomorrow we're going to be looking at that labor market print. And we're going to be looking at it, and we're going to be identifying our levels, and everybody's going to be looking at that labor market print. What I'm going to do on the first part of that print is allow the algos to play out a little bit. I'm going to allow those algos to play out a little bit to see where the real pricing is. And as that establishes that opening range on the candle, okay, that first 15 minutes, that's where I'm going to kind of dial in where can that 5-minute chart at that point, where can it develop into a breakout? I am not looking to trade a pullback in the initial report, guys. I'm not. I'm looking to see the development in the first 30 minutes to see if I can get a breakout with momentum. Does that make sense? That's what the data suggests to me, is within the first 30 minutes, identify a breakout situation. 3 out of the 4 would have worked out in the last labor market prints. Yeah, I saw Kobayashi. I saw them put that out there. Okay. But does this help you guys kind of understand how the labor market report kind of works out over time? And is there any questions does anybody have on the labor market print tomorrow or on anything we've discussed so far? Yeah, they there's a lot of that bear. There's a lot of that bear porn on Twitter. I don't know if I would call them that, honestly. They have some pretty good data. Um, I don't mind. I follow them. They're not a bad follow at all. It depends. It depends, RQ. I mean, honestly, in the first one, it was one of those situations where, like for example, let's go do something here. Okay. So in this first one here, okay, you're looking at the environment of the first report here. Okay. Yeah, I agree with that, Ace. I agree with that. Like, I don't mind any degree of data. I love data. Everybody loves data. Um, I just don't love it when you get bad actors that manipulate the real meaning of the data and they know it. Like, there's a lot of ignorance on Twitter, and we see that all the time. People's opinions on data that they just shouldn't have because they just don't understand it themselves. What drives me crazy is when people do know how data works and they use it to manipulate certain things. That's what I hate. Exactly. You know what, RQ, I think we should all agree with that. Like, my opinions of the data, we can all accept. Other people's opinions of the data, no, come on, they're not part of BluSky. What are we doing? Um, I kid on that. I kid. I'm not talking about people that have a difference of opinion of the data. I'm talking about I see a lot of people, and I know a lot of people in this industry, and I know some bad actors who manipulate data for visibility purposes. And I hate that. It drives me absolute crazy. You can spot it like a fly on you know what. Like it just drives me absolutely crazy. Now, coming back to the conversation here. What I like is when the volatility of the initial economic report, when that volatility coincides with a key level that I'm already looking at. And that gives me a lot of confidence in that level moving into the future. And so, for example, when we were looking at that first report, the one that came out last month, the first initial candle just kind of established the range, right? You had that range kind of come here and that range come right here. Now, do you see how on the support side of the equation, the wick coincides with this body support level right here? It just so happened to be right there at 6,300 as well. And so the opening range here, that wick kind of came down into a known level of support, obviously a significant whole number. Now on the top side, it didn't do that. On the top side, there was no real level that you could see in the initial data set here that you would say, okay, that's an important level of resistance. But the support level certainly was one of those important levels of resistance. And also, oftentimes, did the ultimate conclusion of the data, did a lot of times it just continue the previous trend? Did you guys see that, by the way? That like not one reversed the previous trend. Like they were all choppy and volatile, but the conclusion was the conclusion of was the continuation of the previous trend. And so that's something to keep an eye on tomorrow, by the way. That's something to keep an eye on. Bulls have that control going into tomorrow. We'll have to wait and see what that initial trend is in the morning, but that did stand out to me, honestly. And by the way, guys, I did a lot of this live back testing. Like, I didn't go out and detail all of these technical thoughts before the lab. I just kind of wanted to do that with you guys in front to see if we could see something collectively. Now, I do remember trading these environments, but I didn't go back and really kind of dial it in other than identifying the dates, because I wanted to look at it with fresh eyes the same way you guys were. Now, when you're looking at the ES here after the initial data set here, okay, it comes into the market. The initial response is up. The secondary response is a profit taking situation. Okay. Do we have an opinion yet on this candle right here? Do we have an opinion yet? Should we have an opinion? Yes or no? No, not yet. Not yet. Now, maybe I have an inkling that 6,300 is going to play a role. Maybe, but I don't have an opinion yet. Okay. Now, this candle here, a little bit of an inverted hammer coming into support, right? I might not have an opinion, but am I getting ready to take action? We're developing right at that support level. We're kind of coming in really close to that range right there, getting close. Okay. Now, this candle here, should I be ready to take action if it breaks? Should we be ready to take action if that breaks? Yes. Okay. Yes. Now, the question is, do you need to see confirmation? Okay. Because Nacho, If you're anchoring on a 5 minute chart, for example, do you need to see that 5 minute candle close underneath your support level? That's a question for you. There's not a one size fits all on that. Do you need to see confirmation on that? Yes or no? Yeah, that's how I see it. Gabber, 100%. That's how I see it personally. You know you more than I do. Okay. For me, it's going to be a question on the cleanliness of that level. Do I feel comfortable getting an order in underneath the level to get triggered in as it breaks? Or do I need to see ultimate confirmation and close under the level before I make a trade? That's a question for you. Now, in this specific example, though, would you have said, I need to see a close under that level? Is it clean? Is it dirty? It's pretty clean. It's pretty clean. I wouldn't need to see confirmation here, personally. Now, in a couple of the other examples, I would have. But in this one, I would not have needed it. No. I would have had an order right underneath 6,300 to get triggered in, right, aggressively. Okay. And the reason, very specifically, the wick drilled 6,300. Like it drilled 6,300. Like the wick here, it didn't drill at 6,275. It didn't drill at 25. It drilled at 6,300. Very clean test on that at 6,300. And you got the body evidence over here. So you got a couple wicks, but I would have discounted those wicks. In fact, I did discount those wicks. And so here, it's because that cleanliness of the wick here that I would have been a little bit more aggressive. If this wick was underneath that, I would have said I need confirmation. Ace, I just have a lot of confidence when it does that. It increases my confidence so much when I'm anchoring on a level and that level gets drilled to the penny. I just it just increases confidence. And when you have an increased confidence, I like to push it a little bit. With when I'm a little bit shaky on my read and it's not as clean, I basically you hear me say it in the stream with Riz all the time. That's in that environment. I need to see confirmation. And so, like, I constantly talk about this, and we've had these conversations in the lab quite a bit on to confirm or not to confirm. Confirmation v non-confirmation is not, it's only a matter of how aggressive you are. The most aggressive trader still needs to see price get underneath the level. The most conservative trader needs to see a close underneath that level. And again, I've long held the belief that I don't know you the way you know you. You just have to logically go through the decision making process, right? Is it clean? Is it dirty? How aggressive can I be? Where's my confidence? Those are all questions that you answer in the real time. And when I'm looking at this situation, because, and especially with a significant whole number, I think that plays a role here on this one as well. But once that starts going underneath that 6,300 zone, let's start fast forwarding here. Let's go into that fifth 5 minute chart here. Just give me a second there. Okay, so once you kind of come into that 5 minute zone here, here's the range again. Once you come into that 5 minute chart, you see it kind of testing low, testing low, testing low. That order's there, guys. That order, because of that cleanliness here, that order is going to be right underneath it. And again, I'm not talking about 5 points underneath. I'm talking like less than a point underneath it. That will get right underneath it so that when it does trigger, so for example, let's just say I want to get under that wick right there. Okay, let's give it a little bit there. So a little bit like a point there. So let's just put it right there. All right. So I got myself stop in right there. That's my order to get triggered underneath. And so as it goes forward a little bit of time here, let's just fast forward just 5 minutes or so. Okay. So you kind of see how it plays out here. It's kind of just drifting lower, drifting lower. I also like the fact that the 9 EMA is now playing a role as resistance right there, kind of putting pressure on that 6,300 zone. I'm just waiting, waiting. Again, to me, the order's already there. But if you're more of the conservative type and you want to see confirmation here, I say it all the time. I love confirmation. And so you just wait on that to get closed underneath that level. And once it goes underneath that, you get triggered in. Now, the question is, then on the management side of the equation, because this is a momentum trade, you're gonna basically trust your eyes on reading the momentum of the candles. You certainly want to look left to the chart to understand, all right, where is those major levels on longer time frames, for example. In this situation, you certainly would have been targeting down here. There's a triple quadruple bottom right there around the 61 level. That seems like a really, really, really good target here. And so you're basically looking there and you say, okay, I got that target. Let's see what happens there, coming back into that 5 minute time frame. And you're just looking here saying, okay, I don't care what happens here. We got that order underneath the low here. So when it triggers underneath, we get involved into the trade. Does that make sense, everybody? Is everybody good? Did this conversation on the jobs report help you guys understand kind of how to navigate these economic reports? One key for me when I learned how to trade economic reports, and economic reports will teach you valuable lessons along the way. But one of those lessons that I learned along the way, guys, is patience is required here. Patience in allowing this to develop is required. A lot of times people want to get very aggressively involved because they see these big red candles and big green candles. They're like, oh my goodness, if I just would have made that order right then, I would have been up this money. And then all of a sudden the next candle wipes you out. Like, patience is required. Allow patterns to develop at those key levels. Identify the range after the report. And again, I'm talking secondary setups following economic reports and how I trade this. Okay. And so you allow that secondary development to occur. You identify the ranges from the release of the report. You obviously know where your levels are going into the report. Once we identified that, we felt comfortable underneath 6,300. We put the order in underneath 6,300. Now let's go fast forward just a little bit of time here. And that's how it played out. And it continued along those lines. And so in most examples, outside of the first one in May, the first one in May just took off. Like it literally just took off. That first one in May, when you come back out a little bit of time here, where is that one again? Oh, I gotta get out of the on demand. This one here. Oh, I'll go back 20 days. This one here. This one here was the only one that kind of ran. And then once it got extended, it's a little bit of a pullback. That pullback certainly could have been traded. But outside of that, like it took about 30 to 45 minutes to really kind of set up. There's no doubt about that. Um, questions, questions, questions. Okay. Last thing I want to do in the lab today is I want to take a look at the market from a this week perspective. Okay. And I want to talk about what I felt were some of the best triggers this week. Now, all of you guys, did you guys have a good week trading so far? Everybody have a good week trading so far? I think 30 minutes is about the time frame where you get secondary development. Yes, Ace. Like that's kind of the time frame that I look at. It can happen quicker, by the way. It can happen quicker and it can take longer. but I would say in general, usually about 30 minutes. It's always a minimum of 15 minutes for me, like always. Like, you know how on an earnings trade, when everybody's talking earnings, I usually say I don't make trades 2 days in front of earnings and 2 days after earnings. That's kind of, a hardcore rule for me. It allows me to allow volatility to settle down after earnings. And in economic reports, I don't have a hard rule that says you have to wait XYZ, or I don't have a hard rule that says you have to wait, 5 minutes, for example. A lot of very, very, very aggressive traders can trade these things on shorter time frames. And I'm not trying to judge that. What I'm trying to suggest is that when you look back historically, it took about on the shortest time frame to develop, it took 15 minutes, and on the longest time frames to develop, it took 45 minutes. And so, yeah, on average, takes right around 30 minutes, I would say, on average. And by the way, that's been the case for about a few years. By the way, a couple triggers I want to talk about very quickly here today. Um, I thought there was some really good triggers coming into the week from a technical perspective. I just want to kind of identify a couple of them that I felt were a little bit stronger than others. These are not triggers that I traded like all of them. There were some I did not trade here. One of the best triggers this week was the opening trigger on Tuesday night during the European session. Do you see how support gets dialed in here, dialed in there, and then you break support right here? That to me was the trigger of the week, honestly. I thought this, looking back, that was the best trigger we saw all week long. Not a lot of people traded it because it was obviously the European Open there, but just from a violation of support, like this is what you want to see in a violation of support. Something that gets dialed in, tested over multiple days. Once that violates that I thought that was just a pure trigger earlier this week. And that obviously set the stage for a pretty nasty Tuesday session. But in that Tuesday session, and I didn't trade quite anything in this session right here. My first trade was actually right here on the increase in support as we were coming into power hour. I really, really liked this setup here, guys. First and foremost, I love a reversal situation. I had this as a little bit of a deeper retracement. That's the first stage in a reversal situation on a V-shaped recovery. And once you clip above that 20 period moving average here, you no longer see it through a retracement necessarily. And then you see how it increases its first level of support right here. I loved this setup here this earlier this week. It was right coming into power hour. It was a fantastic setup, and that the Bulls took over from here. And this was one of those setups that I felt really. I thought there was two setups that ripped the heart out of the Bears this week. This was the first one. It was on Tuesday trading session coming into the close, and we had a fantastic close that day. That was a fun power hour, by the way. That was a very fun power hour. On Wednesday, I didn't really see any major triggers on Wednesday night. But if you fast forward to Wednesday, there was a situation on Wednesday. I missed it. A lot of traders of BluSky in the stream caught it though. I did miss this one. Um, and the reason I missed it was I was ready for a bearish trade. And sometimes I have a hard time when I'm ready for a bear trade and the bulls take over. I thought this one really set the stage for today. I thought this setup here, right here, when you were coming into power hour yesterday and you were kissing up against the same support level that kind of dominated the overnight action, you were dancing that number on Wednesday. And I even said on Wednesday when we came into power hour, I'm like, I'm kind of looking at the downside here. And Riz is like, no, I kind of like the top side here. Well, Riz was right on that one because it blasted that resistance level. And I just felt like I didn't make the bear trade because I was waiting underneath those lows there. But I just felt like that reminded me that I shouldn't be that aggressive as a bear. And I just felt like that kind of told the Bears a little bit of something. They had two setups where if they would have blasted, they would have controlled throughout the week, in my opinion. This setup where the increase in support and the Bulls took over, But this one right here, where you got a low base, right there waiting at a key level of support, where if you break this base, guys, you're dancing the lows again. Very easily, you're dancing the lows again. And that didn't occur. That came right back up, blasted that resistance level right there. And ever since then, like the Bears really never had anything since then. Like even on the pullback here, nothing, just a benign pullback on the overnight action. They didn't even dare sniff anything on the cash open. They didn't dare sniff anything. Even after we saw a little bit of a shaky first hour in the market, testing underneath some support, bulls came back out. And once they broke out, which I felt was a great trigger today, about an hour after the market opened, once you cleared that opening candle range, once you cleared that previous resistance, because the orb right here, that was not just the orb range. That was the previous high from the overnight action as well. Remember, we talked about that when we had that lab on levels a couple weeks ago. I felt like that was a clean trigger here today. I thought that was a really good trigger to the top side. If you took that trade, congratulations. Felt that was a very, very, very good one. I also felt this candle right here at the 115 time frame, after the market initially surged on the after the breakout, you got a little bit of dose of consolidation, and that 15-minute 9 EMA caught up to it. I love that technique, by the way, when the 15 EMA catches up. Once that caught up, confirmation close, off to the races. Thought that was a great trigger as well. Now, the third trigger I felt was good looking back historically. I did not love at the time. I love this trigger. I love this trigger. I didn't really love the 6,500 trigger. Don't get me wrong, I was happy with it. I just didn't love it as a new entry. Obviously, I was wrong. Market broke up, continued to go up, and now it's developing into a high base. Did anybody hit trigger number one, trigger number two, or trigger number three today? One is on the opening breakout. Two is on the mid session afternoon breakout, and then the third was coming into the close. I want to see who drilled those. You sat on your hands, Ace. I thought the opening breakout Primo was fantastic. How long did you carry the trade? Yeah, I wasn't comfortable with the third one, Gabber. I just wasn't comfortable with it. And it had nothing to do with the setup. The setup was clean. Like I was a little bit weak on that one. I thought we were extended coming into major resistance, and I thought the market might lock a little profit in front of labor tomorrow. I was wrong. Like market's like, nope, we're pump. We're pump, 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 pump. Um, yeah, it was fantastic. All righty. Did you guys have fun today? I love talking shop, love talking technicals. Uh, next Thursday, Ace. Next Thursday. I don't publish triggers to people. Blas. I agree there, Ace. I agree. I've always said to people, getting somebody's entry is worthless. I believe that. How many of you agree with that, by the way? Knowing somebody's entry is worthless. I don't believe it's helpful at all, because you also need to know how they're managing the trade. Wouldn't you agree? That's where the real skill set is. Tipped, I agree with that 100%. 100%. 100%. 100%. 100%. All right, guys. Well, with that said, I hope everybody has a blessed and wonderful rest of your day. Thank you so much for coming out to the BluSky Lab. And just a little bit of a word from me, Coach Matt, to you guys. I just want to say thank you. I want to say thank you to always coming out and supporting this lab, supporting what we're trying to do at Blue Sky in putting the education, the application together. Coach Riz does a wonderful job. Blue Sky team does a wonderful job. But I just want from myself to you guys, I just want to say thank you. You guys are awesome. You're amazing. You come out to the lab, you participate, you do a great job, and I just want to say thank you. So I appreciate you guys' time. I appreciate you guys coming out and supporting the lab. And as always, I hope you guys have a wonderful, wonderful rest of your day. Thanks, everybody. Thanks, Wiggle. I've been a part of Blue Sky now for about it's been about 5 months now, and I'll tell you, I'm very impressed by them. I love this team. Great people. To from the very tippity top of the company to you name it. Like everybody cares. Everybody's on united on the same team, and I just think it's a wonderful, wonderful environment. It's a wonderful environment for traders. It's a wonderful environment for people wanting to learn how to trade. And those are the two things that I value: education and application. And Blue Sky does a fantastic top tier job at both of those two. And that starts with the top. That starts with top. Mike, Rich, Steve, like they're all amazing. Oh yeah. Oh yeah. Oh yeah. Oh yeah. Lots of good things coming down the road, guys. Lots of good things coming down the road. All right. You guys have a wonderful, wonderful rest of your day. I'll have the lab up tomorrow for those of you that want to view it. And I would love it if you guys watched the lab on YouTube, gave it a nice little like and a comment to help us to increase that visibility on our Blue Sky YouTube channel as well. I'll put that link in chat tomorrow. You guys have a wonderful night.